We're still getting a few dings, people coming into the lobby, but we are going to kick off. So welcome to the Commerce Commission session on Default Price Quality Paths 101. The intention for this today is this is a knowledge sharing session about our upcoming reset of the electricity distribution businesses default price quality path, which applies to non-exempt businesses. So my name's Simon Wakefield. I'm a principal advisor in the Price Quality Regulation branch, and I'll be facilitating today's session. We'll come back shortly and talk to housekeeping issues and the purpose of the session today. But first, I'd like to introduce Josh Riley, who's an analyst working on the DPP reset for an opening karakia, who'll be followed by Rebecca Henderson, who's the manager of our engagement operations function for a mihi.
Cool.
Excellent.
Okay, thank you, Simon. Tēnā koutou katoa, ko Josh toko ingoa. I'll begin with the karakia. Tu taua mai I runga, tu taua mai I raro, tu taua mai I waho, tu taua mai I roto, kia tau ai te mauri tū, te mauri ora ki te katoa, haumi e, hui e, tai ki.
Tai ki e. E rere atu ana nā mihi ki a koe Josh I tō karakia he a tāhua. Kātia no kia mihia te mana whenua o tēnā rohi, o tēnā rohi, o tēnā rohi. Nā mihi ki ngā tāngata kua whetū rangitia, ka whiti o rama mō ake tonu. Nau mai haere mai ki tēnei kaupapa.
Fantastic. All right, thank you very much, Josh and Bex. So thanks everyone for your attendance today. We are hearing a number of things coming through, and I can't see the number of attendees, but we did have a lot of registrations. So it's fantastic to have a large number of people turning out and not just representatives of the regulated entities themselves. Today's presentation will be provided by James Mulrennan, who's the Chief Advisor in our Price Quality portfolio, and he'll outline the structure of today's session. But I'm just going to talk over a bit of the housekeeping, but also like to acknowledge that we will be having James O'Donnell and Gary White from the Electricity Authority will be presenting a short session later. The Commission and the Electricity Authority have been making a conscious effort to reach wider audiences and inform our complementary roles in regulating the electricity market. And it's great to have James and Gary able to say a few words later in the session about the work of the authority. So we'll be running this today as a fully remote session. We do have the raise hand function and the chat function, which we'll be monitoring throughout the session, and we'll endeavour to respond to your questions as we go, or at the end of the session where we will have a question session. Please make sure your cameras are switched off and your microphones are muted throughout the meeting. However, if we do invite you to ask your question or you have a particular question to ask, it'd be great to have your camera on. And also this session is being recorded and it'll be added to our website so you can view that at a later date, as well as the slide deck. So this slide outlines the purpose of today's session. As many of you probably know, the Commission has commenced our process for the fourth reset of the default price quality path, which applies to electricity distribution businesses. So each EDB reset has novel and significant issues to consider, and this reset is especially important with the developed government policy on climate change, facilitating the transition to net zero carbon emissions by 2050. With advances in technology, changes in consumer preferences, and an inflationary environment and supply chain constraints, there is certainly a lot of issues for us to consider as part of the DPP. So your input into the DPP will be crucial to getting the best outcome. So we want everyone to have a good grounding in how the regime works. So the session isn't about specific issues and how they may be accommodated into the DPP. We will provide plenty of opportunities in terms of consultations and future workshops to discuss the issues. It is really to give people a good grounding of the DPP regime and how it sits together. I'll now hand over to James Mulrennan, who's going to take you through the DPP 101. Thanks, James.
Thank you, Simon, and good afternoon all. So I'll just start by outlining what we're going to be covering in today's session. So the first section covers off the sort of context we're operating in, a little bit about the Commission, why we do what we do, and the Part 4 regime generally. We'll then go into a sort of general overview of price quality regulation as it applies across the board. Then into some of the specifics about how default price quality paths operate and the dynamics there. And then finally close out with a little bit on the context and process for the DPP4 reset. So beginning with the context, this will cover off the Commission's role in the electricity sector, the purpose of Part 4 and the regulatory principles that we operate with, how we regulate electricity distribution businesses, and then a word from our cousins over at the Electricity Authority. So starting sort of right at the highest level, what I've got on screen here is sort of the Commission's overall vision for what we do, and it really focuses on New Zealanders being better off because we have well-functioning markets that both consumers and businesses are confident participants in, and then sort of about what our role there is. Obviously, we have a range of responsibilities under different acts, competition, fair trading, consumer credit, but most importantly and interestingly, we work as an economic regulator in the infrastructure sector. So a bit about kind of what that means in practice. What I've got on screen here comes from our latest statement of intent and really gives a view of, trying to articulate what we're about. For obvious reasons, I'll focus on the essential services pillar, as that is most directly relevant to our work under Part 4. So we talk a lot about economic regulation, infrastructure regulation, significant market power, but fundamentally the sectors we regulate, what they are is essential services that are kind of fundamental to life in a modern economy. So it's really important that consumers are getting good value and good quality out of those services, that there's a watchful eye is kept on performance of how that infrastructure is performing, and there's a limit on the profits that businesses can extract from offering those services. And I'll touch more about how price quality regulation and the DPP specifically helps achieve this as we go along in the presentation. So turning to our role in the energy sector specifically, the Commission and the regulation branch are a creature of statute. Our powers, functions and duties come from Part 4 of the Commerce Act. What this sets out is that there's two forms of regulation that apply, which I'll go into a bit more detail, in markets where there's limited or no competition. So effectively dealing with monopolies, and ensuring that where we don't have that competitive pressure from markets, we've still got pressure for businesses to deliver good outcomes for consumers. So our role is both to determine the content and scope of these regulations, and then to monitor both compliance with them and the performance of the sectors we regulate under them. So in terms of the statutory purpose we operate with, this is kind of the Part 4 purpose is effectively the regulation branch's source code. If you're ever looking for the answer to a question, why is the Commission doing that, or why did the Commission take that approach, it really should be linked back to this purpose. So just going through it item by item, what we're here to do is promote the long-term benefit of consumers in these markets, but that's focused on the incentives that suppliers in those markets have, and particularly incentives to innovate and to invest, to improve efficiency over time and to provide services at a quality that meets consumers' demands, to share those efficiency gains with consumers, including through lower prices, and are limited in the ability to extract excessive profits. So that's a lot of words on that previous slide. So we kind of distilled that down to what we call sort of 6 performance areas, reflecting the language of the Act. So as you can see on the screen, those are investment, innovation, efficiency, quality, pricing, and profitability. I'll refer back to these as we're going through the presentation, so hopefully you can see how the decisions we make are linked back to those outcomes that we're after. So while the statute is our starting point, we actually need to do something with it, and it doesn't answer every question on its own. So I'll just go through sort of a bit of how we've interpreted the Part 4 purpose in practice. So often we'll refer to regulation under Part 4 as incentive regulation, and that's because our goal is very much to align suppliers' incentives with good outcomes for consumers. We're focused on the defined outcomes listed on the previous slide that we see in workably competitive markets, rather than on any particular market mechanism or market outcomes generally. The regulatory system operates as a whole, so rather than every decision having to draw on every element of the purpose, our goal is to ensure that the regulatory settings we have as a group work to promote the overall outcome. There are other considerations, obviously, that either we have to in some cases or may in others take into account. These are things like specific statutory purposes for input methodologies or for ID and PQ, or things like the provisions of the Zero Carbon Act that relate to emissions budgets or decisions taken by the Electricity Authority. None of the Part 4 outcomes are paramount over the others. So ultimately, that requires a balancing act when the Commission comes to make decisions. And then finally, to help in applying that adjustment in a consistent way, we've set out a few economic and other regulatory principles that help in making that balancing exercise consistent. So I'll touch briefly on the economic principles at this point, as they apply across the broad range of what we do in the infrastructure sector, but I'll touch on some of the more specific default price quality path principles as we get into it. So first off, we have what we call the expectation of a normal return principle. This is one that you've probably heard a bit about if you've interacted with our work, but in simple terms, what this means is we provide the opportunity, but not the guarantee, of a supplier earning a commercially realistic return on its investment over time. Second principle we draw on is that what we call the risk allocation principle, and effectively what that is risks should be allocated to the parties that are best placed to manage them. So that's things like cost risk, demand risk, or inflation risk. And then finally, we sort of acknowledge the asymmetric consequences of under or over investment. So effectively what that means is that for consumers and for, from a New Zealand Inc. perspective, I guess, that underinvestment over the long term can lead to worse outcomes. Just a few caveats on those principles. Ultimately, they're a tool that support our decision making, but they don't override the purpose of Part 4 or our other statutory obligations, and they're not kind of a set-in-stone regulatory compact, but we do find them quite a useful framing device for some of the decisions that we're called on to make. So turning to the substance of Part 4 regulation, so I'll start just by mentioning the input methodologies. These are the basic rules and principles that underpin the forms of regulation we have. They're currently being reviewed, so I won't go into too much detail on those. Then we have information disclosure and analysis, so colloquially known as sunlight regulation. Effectively, what this requires of all businesses regulated under Part 4 is to publicly disclose certain specified information so that the Commission and other stakeholders can see how they're performing. And then obviously price quality regulation and the enforcement of it, which is the focus of today's presentation. So a brief word on the input methodologies, as they're pretty fundamental to the work we do and have a lot of interrelationships with price quality regulation. These are basically the regulatory rules that underpin Part 4 regulation. So they apply to things like allocation of costs between regulated and unregulated businesses, valuation of assets, cost of capital, taxation, but also process rules like the circumstances in which we'll reopen a price path or the information that needs to be provided as part of a CPP. The purpose of the IEMs is to promote certainty over the long term for suppliers and consumers, so that we specify a lot of these fundamental rules in advance before we come to apply them under price quality or ID. As I said, they're set up front and are reviewed at least every 7 years, and we're currently going through that review process at the moment. The Commission's obliged to apply the IEMs when undertaking actions under ID or PQ, and so are suppliers that are regulated by Part 4. Not everything is covered by the IEMs. So in particular for price quality, the way expenditure forecasts are created and the way we regulate quality are outside the scope of the IEMs. These are determined at each DPP reset, and so there'll be quite a focus of the remainder of today's presentation. So talking a bit about our role in the electricity sector specifically here, I'll skip through this one pretty quick because I imagine some of this is pretty familiar to most of our audience. But basically the Commission regulates the monopolistic parts of the electricity value chain. So that's the transmission grid, which Transpower operates, and the distribution grids that distribution businesses operate. And obviously the focus today is on distribution businesses. It is worth noting though that the Commission's broader powers in terms of fair trading or competition do apply across the board. But yeah, focused specifically on Part 4 today. And then sort of bringing those two things together in terms of the scope of regulation and the electricity sector, all 29 electricity distribution businesses are subject to information disclosure regulation. And then a further 16 of those, which are the ones highlighted in dark green on the slide there, are subject to PQ regulation. So we refer to these as price quality regulated, or sometimes slightly more wordy, non-exempt EDBs. You should. So yeah, as I was saying, the regulatory status there between price quality and information disclosure depends on whether or not a business is fully owned by consumers. And it's a matter that's determined by statute. So the Commission's not the only player in the electricity regulatory space. There's also some responsibilities held by the Electricity Authority. So I'd invite our colleagues from the EA to come in and speak a bit to the slide here.
Thanks, James. I'm James O'Donnell from the Electricity Authority, and yes, it's good to get some context in terms of how the regulatory landscape works. What role does the Electricity Authority have in this space? Well, the ComCom and the Authority have joint regulatory oversight over the electricity distribution and transmission space. We both have our empowered by our own legislation, the Commerce Commission through the Commerce Act and the Authority through the Electricity Act. We work alongside one another as adjacent regulators, working in tandem and collaborating with one another. In very high level terms, we share oversight of the EDB regulation. The ComCom sets the price quality standards for most electricity distributors under its DPP regime, which includes setting its maximum allowable annual revenues. The Authority has oversight over the distributors' pricing methodologies, or how they set their prices in order to recover those allowable revenues. Or put another way, the ComCom sets and decides the size of the entire pie, and the Authority oversees how the pie is divided up and who pays for the pie. The Authority is currently examining the pricing methodologies of the electricity distributors. We recently released our draft scorecards just yesterday to many EDBs, and we also released an issues paper targeting 5 specific areas of distribution pricing reform we're going to be looking at. A consultation closes on that next Tuesday, the 15th of August, followed by 2 more weeks of cross-subs. We're also doing various non-price focused work on distribution. That's including access to data and information, market settings, including non-network solutions to improve network capacity. And we're also reviewing Part 6 of our code, which examines DER standards and connection standards and processes for getting connections. There's a number of areas where there is a slight bit of overlap between the two, and there might be some overflow in terms of the work that we do may flow over into some work that the Commerce Commission does. For example, pricing of connections and new connections. Naturally, we'll be working closely and alongside the Commerce Commission staff in the next months or even year or longer on the interdependencies of these working arrangements and programs. Many thanks. Back to you, James.
Cool. Thank you, James. Yeah, I think really important to mention the overlaps there, and obviously the Commission does have an explicit requirement on us to consider the work that the Authority's doing. So we'll probably more on that over the course of the next 18 months or so. Just before I launch into the overview of the price quality regime section, was there any questions either in the chat or just by raising your hands on the sort of context section there? Cool. Phil, I see we've got a hand up there from Phil Campbell.
Yep, can you hear me?
Yes, we can.
I just noticed when you talked about the Act under PQ doesn't guarantee an allowable return. What happens if you have a situation where you know, a company was to under recover for a period of time? What happens in that situation? Because obviously there is no guarantee you can fully recover. But is there any angle in the Act which would allow for some sort of adjustment to allow higher allowable revenues?
Yeah, so I think I'll start with the kind of principal aspect of that question. Is that it's a regulatory principle that we've developed. It doesn't have a statutory mandate of its own, but I think if I understand what you're referring to specifically, would we be allowed to allow for past under recovery? Yes, and in certain circumstances we do. I'll touch a bit on it further in the presentation, but we have what are called regulatory wash-up mechanisms, where we specify in advance that certain factors, if those lead to an overall or under recovery of the revenue allowance, then that will be able to be carried forward. But it's sort of that doesn't apply to everything. So the expectation and the expectation principle is I guess it's from an ex ante position. So it's at the point where we set the price quality path, it's done with the expectation that there'll be a normal return, but it's not done with a kind of washed up guaranteed promise. If there are shifts in EDB's cost base or efficiency or changes to quality, then those can get factored in. But yes, there are circumstances where we can provide for a wash up if there's going to be under recovery over time. Does that answer the question?
Yep, I suppose if the under recovery was due to some sort of new technology or competition, then you know how would that work? Because obviously the wash up will allow you to increase your prices by more, right? But if you've got if you actually got competition, which is emerged, given this Act is designed for industries where there's limited competition, you know what happens in that situation? Because even if you increase your prices, you just end up potentially under recovering more if people are shifting to a different technology.
Yeah, no, I think it is a good question, and it's one we've had to tackle as part of our work in the fibre space. I think it's been less of a consideration on the electricity side, given that we sort of hadn't seen as much evidence of that kind of competitive stranding of the RAB. But I think ultimately the revenue path can only, make those promises within the boundaries of the regulations, and ultimately if market structure changes over time, we can only balance things around the revenue allowance. But I think there are other things that we do to reflect the possibilities of competition developing in those markets. So I think there was an asset stranding allowance as part of the regulation of Chorus under that Act. So yeah, I think that's the sort of a bigger picture question that goes beyond the limits of what the revenue path can deliver.
Great, thanks.
Yep, thanks, Phil. Was there any other questions, or we'll launch into the price quality section? So in this section, we'll cover kind of price quality regulation generally. So starting out with why we set price quality paths and what we're trying to achieve through setting them. A bit about the CPP DPP regime overall. Some points on why we reset price quality paths, and I think some of that does come to what was in the question earlier. How we set price paths, how we set quality standards. Cool. So starting out with why, the straightforward answer is because the Commerce Act says that we're required to. But in terms of what we're actually trying to achieve through price quality regulation, it really comes back to those performance areas I was speaking about before. So by limiting the revenue that a business can recover, that helps limit the ability to make excess profits and ensure that prices reflect efficient costs. Allowing EDBs the prospect of recovering that investment encourages investment, and to earn a return on it encourages investment. Providing an opportunity to outperform the forecast that we set rewards innovation and encourages businesses to find efficiencies. And then finally, setting quality standards and incentives encourages EDBs to meet consumers' demands in terms of quality. And I'll go into detail a bit more about how these dynamics work as we go along. But to answer a sort of maybe simpler question, what is a price quality path? It's fundamentally made up of two things. The first is a limit on the revenue that a EDB can earn from providing electricity distribution services. And the second is a set of standards for the quality of those services. This is then supported by other requirements. So these are things like incentive mechanisms or compliance and information requirements. Also, sometimes when we refer to a price quality path, price quality paths are periodic, so we'll often refer to specific periods as a price quality path. For example, we're heading into DPP4 over the course of next year. Just a brief aside on some terminology here, because it sometimes gets a bit confusing, even for me. When we refer to price under Part 4, in the EDB context, we usually mean revenue. I know that's somewhat unhelpful, but the reason for that is the Act gives us discretion for how to specify the price. There's an entire specification of price IM about this. And a decision we took in the 2016 IM review was that EDBs would be subject to a cap on the amount of revenue that they can earn. That decision's obviously being reviewed in the IMs at the moment, and see the draft decision that proposed no change to that. But fundamentally, price as it applies to EDBs usually means revenue. So just bear that in mind as we're running through the presentation on the price path. So in terms of price paths, there's two forms that we set. The first is a default path. The second is a customized path. Both of these forms of regulation are aimed at the same thing, aimed at those same incentives and outcomes that I was speaking to, but go about it in different ways to achieve slightly different, to respond to different things. So the default path is the one that's generally applicable to all businesses, and it's the path that all businesses start on. However, if the settings for that aren't right for that business and for the needs of its consumers and its reality, it can apply for what we call a customized price quality path. These are more business specific, relying on more in-depth information, verification and evaluation, effectively because there's a greater departure there from the status quo that business consumers have come to expect. So there's a greater need for scrutiny of those forecasts and those plans. So in terms of the sort of that spectrum between DPPs and CPPs, rather than seeing it as two completely distinct categories, over the course of some of the work we've done, we've come to think of it as sort of being on a spectrum. With at one end, you've got DPPs, and at the other end, CPPs and reopeners for them. And basically what you see as you go through those is an increasing departure from the status quo settings between the DPP and the CPP, so changes to quality standards or changes to the costs of delivering that level of quality. What that means in practice is that there's an increasing need for scrutiny of those plans in order to ensure that consumers are getting the right mix and good value there. So in between the DPP and the CPP, sort of on the spectrum that we lay out, we have things like pass-through and recoverable costs, which allow the path to vary as the period goes on. I'll speak a bit more about those in a moment, and also defined reopeners to the DPP to respond to certain defined circumstances. So in terms of the key features of the default path, which is the focus of this session, it's the path all the EDBs default to. We set it in a relatively low-cost way. This is language drawn from the statute. And in order to achieve that low-cost limit of the purpose, we apply a few principles. One is that We apply the same or substantially similar treatment to all regulated businesses on the path. We set the price and quality standards with a reference to revealed performance or historic performance, but also with the ability to make adjustments at the margin to adapt to how things are changing. Within those sort of broad cost quality settings, there's a reasonable degree of freedom for EDBs to make trade-offs between cost and quality. And I'll talk about a bit of how that works in the section on quality standards. And where possible, we make use of existing information, in particular drawing on the information disclosed under ID or independent sources of forecasts. And then finally, they tend to last for 5 years by default, but we do have the discretion to set them for as little as 4 if we think there's a good reason to. So the Act, in addition to setting out what we need to do with DPPs, also sets out some limitations on the way that we go about that. And I think these are quite important for understanding why we do things the way we do them. So the first one is that we're not allowed to make comparisons between EDBs in terms of efficiency. So what this has meant is that we tend to base our forecasts on the supplier's own performance, or with reference to independent forecasts like the Reserve Bank forecasts of CPI or what have you. The revenue path can't recover excessive profits during any earlier period. So what this basically means is that we're not allowed to claw back profits that have been made in earlier periods. EDBs get to keep any gains that they make over and above the price path. It's effectively a set and forget type regime. So once the path is in place, there's only limited identified circumstances where we can reopen the path, and we have to apply the input methodologies when setting the default path. And we can't apply new IMs halfway through the period, which is really important for how the IMs promote certainty over the medium term. And it's also why we might make some incremental changes to the IMs in advance of any DPP reset. This reset a bit unusual in that respect, as we've just gone through the exercise of doing the full IM review. So in terms of why we reset the DPP, so the price path's based on forecasts. Over time, forecasts begin to depart from actuals. Underlying assumptions will change, circumstances will change. What this can mean is that suppliers are either over or under recovering their efficient costs. And so the goal of the reset is to realign those revenues with costs and quality standards with changes in performance. And it also gives us an opportunity to bring into effect any changes in the IMs. As I mentioned, can't do that mid-period, and to allow for incremental improvements to how we regulate price and quality. So in terms of sort of illustrating how that dynamic's supposed to work, first of all, you have the revenue path set on a building blocks basis, which I'll go into in the next section. This sets out a kind of P0 or a baseline revenue path. Where suppliers are making savings relative to that path, they get to retain those savings for the duration of the period before those then flow on to consumers. And then in theory, this sort of gives you a dynamic over time where the real prices that consumers see are being reset based on supply performance. So a bit about our compliance and enforcement role. Obviously, it's one thing to set rules, they do also need to be complied with. So in addition to the substantial requirements, we also set reporting requirements, which require businesses to disclose things like how they're performing against the quality standards, what their revenue is relative to the revenue path. Largely self-reported, and we then have broad information powers to investigate if there is a breach that's over and above our powers under ID. We have a range of enforcement measures available to us, and very much from sort of informal guidance right through to formal proceedings. but we try as much as possible to be kind of outcomes focused and solutions focused as part of any compliance work. So if there are any compliance issues, we aim to work constructively on getting consumers a good outcome. So moving on to the details of the revenue path now. Is the price side of price quality. So I'll start out with a walkthrough of how the building blocks formula and model operates. Then a bit about the expenditure forecasts that inform that building blocks model. And then finally a bit on the efficiency incentive scheme that we set. So building blocks are a fairly core concept of the Part 4 regime, to the point where often it's called building blocks regulation, but they're not actually defined in the Act or the IMs. But a working definition that I'll use for the purposes of this presentation is it's a way of determining a revenue allowance based on the sum of forecast costs over a given period. It's basically as simple as we look at what we think the supplier's costs are going to be, add those costs up to come up with a revenue allowance. So there's 5 key steps in this process, which I'll run through here. Effectively, this does involve some maths, but it's basically all at year 10 level, so I wouldn't worry too much. But effectively what this is getting under the hood of what our financial model does. Worth noting that as I go through all of this is all being done on a forecast basis at the start of the regulatory period, rather than being updated year to year. So the first thing we'll touch on is the regulatory asset base. It's a fundamental pillar of the regime. It's effectively the account that's tracking the investment that a supplier has made over time. It's one of the most material variables for working out the revenue path. So we'll go through it in a bit of detail. So the way the asset base step works is on a rolling basis. So closing RAB from 1 year becomes the opening RAB for the next year. We then add to that a revaluation amount. Effectively, what this recognises is keeping the RAB constant in real terms. So it's effectively the RAB multiplied by CPI to get a revaluation amount. We then take away from that depreciation, recognising that the assets have a limited economic life, and acknowledging that declines over time. In the DPP context, this is usually straight line accounting depreciation, but there is some ability for that to be adjusted. We then add to that a forecast of capital expenditure, which I'll go into in a bit more detail in a moment, and then subtract off any assets that have been disposed, which then gives you the closing RAB, and then we do it all again. Just a note on some of the colouring there, you'll note the things there highlighted in blue. Those are matters defined largely by the input methodologies. And then the things highlighted in orange are determined by at each DPP reset, so are a focus of a lot of the consultation and analysis we do in the lead up to each DPP reset. So the second one I'll run through is the return on capital formula. Electricity distribution is a capital intensive business, so the return on capital is a very large determinant of the revenue allowance, and it's largely how we give effect to the real financial capital maintenance principle. So again, I will run through this in a little bit of detail. So we start by taking that opening RAB, multiplying that by the WACC, or the cost of capital, as determined in the IMs. That gives you sort of the regulatory return. We then subtract from that the revaluation that's being made, effectively in the RAB roll forward step. Effectively, what that acknowledges that some of the return that the business is getting is in the form of a capital gain on its existing asset base, rather than a in-year cash allowance. We then add the term credit spread differential to that. I won't explain that. There's a great IMs paper that's just come out on it if you'd like to discuss it in any detail. And then what that gets you is the return on capital. Right, so tying those together, we have the building blocks formula. This is basically the core of the way we set a revenue path. It starts with that return on capital that I mentioned, built up on the previous slide. We then add to that an allowance for depreciation, which effectively allows the business to recover the return of capital over time. Oh, that should not be a minus sign. That should absolutely be a plus sign. But we then add to that the operating allowance, which again, talk to that in a moment. And obviously got to make sure IRD gets theirs. We allow a tax allowance on top of that. And what that gets you is building blocks allowable revenue, which is effectively the sum of those costs that business incurs. The output of the B-bar can be quite lumpy at times, so we do go through a revenue smoothing process. What the Act sets out is that revenue should be increasing at a rate of CPI plus an X factor, so from one year to the next, it should be going up roughly at inflation, and then with an adjustment to smooth that increase over time. So to achieve this, we take the building blocks amount and we add or subtract a smoothing adjustment to come up with the maximum allowable revenue, or MAR. When we're doing this, we ensure that in present value terms over the 5 years, that maximum allowable revenue is equal to the sum of the building blocks revenue, so that it's equivalent in present value terms. And we're nearly done. Final step before we've got to the revenue path. So we take that maximum allowable revenue, we add in on top of that pass-through costs and recoverable costs. Basically what these are is costs set out in the IMs that are kind of above the line, that reflect costs or other adjustments passed through directly to customers. So those are added on each year. And that's how we come up with the revenue allowance for the DPP. So just illustrating what that looks like over time, you can sort of visualize the path as being a sum as we go of all of those building blocks that I mentioned. That then creates a revenue allowance shown by the red line on the slide here, and an EDB is required to price such that the revenue they're recovering doesn't exceed that allowance. Obviously, there might be some difference between forecasts and actuals there, so we do allow a wash up, so it's based on forecast pricing. And just illustrating in year 3 there, that would be a breach of the revenue path. Right, turning to expenditure forecasts, these are a pretty critical input to the building blocks formula we've gone through, and a really material impact on businesses. So again, go through in a bit of detail. The IMs don't specify how we forecast OPEX or CAPEX, so we're not fixed into any particular forecasting approach. So everything I say over the next few slides here will very much be the subject of consultation throughout the DPP reset process. And yeah, in terms of the 2 categories of expenditure we use, for operating expenses or OPEX, we use a base step trend methodology, and for capital expenditure or CAPEX, we have an approach that's been based on the business's own asset management plans, subject to some forms of scrutiny or caps. So starting with operating expenditure, OPEX costs are largely recurring and relative to CAPEX and more stable over time. So we're able to forecast them using a model that extrapolates the current cost base forward. So we call this the base step trend model. 3 components of it, unsurprisingly. First of all is the base. This effectively reflects the business's current operating efficiency, the current costs that they're incurring. For incentive related reasons that I won't go into in too much detail, we use year 4 of the current period, but there is an adjustment to capture any out of trend or unusual one-offs that occur in that year. On top of that, we add step changes. So these are for any new functions, new activities that the business is undertaking, or things like changes in accounting rules that move things between OPEX and CAPEX. And then to that, we add the trend bit. So this is changes from ongoing factors, things like networks growing, customer bases growing, input prices growing, or sector-wide changes in productivity, which then comes up with the OPEX allowance. Worth noting that we do this separately for network costs and non-network costs, just to reflect that there are different drivers behind why the business might be incurring those costs. In terms of CapEx, unlike OpEx, CapEx is not quite as predictable and can be lumpier, so it's harder to extrapolate from existing performance. In general, EDBs each have the best information about their network and about how they plan to manage it. So we've developed a practice of starting with the EDB's own forecasts under the asset management plans that are produced for ID. So that's our starting point for CapEx forecasts. But on the other hand, there can be an incentive to over forecast in order to increase a regulatory revenue allowance as part of that. And fundamentally, there is a limit to what a default path can accommodate and the point at which we need to then move into a customized path. So for that reason, we've developed some scrutiny checks and some caps to give effect to those. We've tended to break CapEx down by driver in order to assess it. So in terms of renewal CapEx, some of the things we've used to assess the network's renewal needs is things like the age of the assets, the condition they're in, or using depreciation as a proxy for those things. In terms of growth CapEx, so system growth or customer connection, the kind of main drivers here we've used is to assess that against forecasts of new connections or of demand growth or network capacity. And then finally, other categories have been a bit harder to assess the drivers of. This is things like non-network CapEx or reliability, safety, and environmental spend. So here we've tended to rely on either looking at what spend has been historically or on qualitative analysis of the drivers and AMPs. And then across the board, we have applied in the last couple of resets an overall cap. The amount has varied between periods and is subject to being sort of reassessed each reset. But basically what that acknowledges, I think, is two things. One is that, as I said, there's a limit to what can be accommodated within DPP and at what point we need to go through a more detailed scrutiny process enabled by a CPP. But then also just concerns about kind of the overall deliverability of a particularly large expenditure program is something we would want to check as part of a CPP process. And then finally in this section on the price path, a little bit on efficiency incentives. So the revenue path does create a kind of natural incentive for efficiency improvements. EDBs get to keep any cost savings relative to the path that we set until the end of the regulatory period, before those are then shared with consumers through lower prices. There's two main problems with this natural incentive, as we call it. One is it's inconsistent over the regulatory period. If a supplier gets to keep a saving for 5 years versus for 1 year, the strength is stronger at the beginning and weaker towards the end. And because of the different ways the OPEX and CapEx are recovered, it does lead to a different incentive between OPEX and CapEx, which can create a bias towards capital investment over operating OPEX solutions. So to deal with this, for the last couple of resets, we've implemented what we call the Incremental Rolling Incentive Scheme, or IRIS. So this is just the absolute basics of IRIS. Definitely a detailed account of this would be DPP4 session at the least. But if there's kind of one thing on this to take away, it's that for every dollar a business doesn't spend, they get to keep 24 cents of it. Similarly, for every dollar of overspend, the business only has to wear 24 cents of that. So in terms of any gains or losses in efficiency or overspends and underspends relative to that allowance, that's measured against the OPEX and CapEx baseline forecasts we set. We then determine a fixed amount or retention factor, currently set at 24%, that determines how those are shared between the business and consumers. And what this leaves us with is an incentive that's symmetric, so it's the same for overspends and underspends. It's consistent, so it's the same throughout all years of the period, and in theory is equal between OPEX and CapEx. And it's constant, so it's the same on every dollar of spend, regardless of where you are relative to the target. So it's a constant marginal incentive. Okay, quite a lot of information there on revenue and expenditure. So before we launch into quality, were there any questions in the chat or by show of hands? Cool. No. Okay. So we've talked about the price half. So now we'll talk about the quality half, the price quality path. So we set quality standards primarily as an incentive for EDBs to provide services at a quality that consumers demand. But they also play a really important role in reducing the risk that EDBs are underinvesting in their networks. And so it creates that incentive on businesses to continue to invest and not just seek to maximize profits by underspending or underinvesting. The Act requires us to specify a quality standard for every DPP, but we are given quite wide discretion in terms of how we do that. In terms of how we measure quality, for electricity distribution, we've traditionally done it on the basis of reliability. So there's two measures that we've used there. One is the frequency, so how often customers experience an interruption on average, and also the average duration of those interruptions. The technical terms of these are SAIDI and SAIFI. And basically what these are is measures of network reliability. The principle we've set out in DPPs has been on a no material deterioration basis. So basically, quality shouldn't be, broadly speaking, getting worse over time, that customers are paying roughly the same amount in real terms to receive roughly the same amount of quality in real terms, but with some adjustments around that, which I'll talk to you on the next slide. Currently set with reference to a 10-year historic period, and then with a buffer above that historic limit to account for some natural variability. We then normalize or strip out the impact of major events like storms or third-party damage. Otherwise, the quality standards will be sort of unduly influenced by these big one-off events, because what we're interested in is the underlying trend in changes in reliability. And then to counterbalance that normalization, we do have a separate standard specified for major events, but only those that are within the EDB's own control. So this doesn't apply to things like storms or third-party damage to the network. Alongside the quality standard that we set, we also have a quality incentive scheme. What this basically does is link together the price side of the path with the quality side, and is intended to really place the trade-off between costs and quality onto EDBs themselves and allow them to make trade-offs within certain margins. So basically how this works is where an EDB outperforms the standard, it receives a financial reward in the form of an increase in revenue later on, or where it's performing below the standard, consumers are compensated for that decline in performance. And those rewards and penalties are set relative to that historic baseline that I talked about before, again subject to the normalization process. Cool. And that is about everything in terms of the DPP primer. So I can turn finally to a bit about the DPP4 reset context and process. Do you want me to give that one? Cool. Just before we launch in, any questions on quality or anything else we've covered? Oh, okay.
Oh, there's a hand up.
Oh, we've got a hand up.
Over here.
Got Alexandra, a question from you.
Tēnā koe, James. I'm just wondering if you can comment a little bit in more detail around the innovation pillar.
Yep, happy to. So the kind of, in a DPP context, I think that the main way we see innovation working is that where businesses are innovating, are finding new ways of doing things, cheaper ways of doing things, better ways of doing things, that over the regulatory period, they'll be the ones who see the immediate benefits from that. So there's quite a strong incentive there, if there is a better way out there, for that to be brought into place. But I think we have acknowledged, and this has come up quite a bit in the review of input methodologies that we've been undertaking over the past year, that there really is a need for more direct or more targeted incentives around innovation. We had kind of a pilot innovation incentive for DPP4, but the draft decision in the IEMs focused on creating a more flexible additional allowance for businesses that are adopting either genuinely innovative new practices or looking to apply kind of non-traditional solutions. So things like smarter demand response or localized batteries or anything like that that's sort of not just conventional poles and wires. So the IEMs have created the option to have a more targeted incentive for that. But I think one of the things we'll be consulting on as part of the DPP is exactly what the size and scope and parameters of those innovation mechanisms should be. I think the final thing I'd say is that we are not experts in innovation or what the best solutions are. So we're sort of broadly speaking agnostic about the kinds of solutions that businesses are seeking out. And what we're really here to do is, number one, is create an incentive for businesses to undertake that activity, but then also make sure that it is innovation that delivers benefits for end users instead of just because it's interesting or for its own sake. It is a good question and definitely been a focus of some of our recent consultations. And then a question from Jacobus.
Hi, James. Thank you for excellent presentation. I'm from an engineering background, so please excuse me. Call me financially illiterate.
No.
So with our focus on improving our resilience in the light of, for example, Cyclone Gabrielle, we definitely need to increase the inventory that we keep in our stores. How is that addressed through the DPP?
No, it's a very good question, and it is something. So this is just so I'm clear. You're sort of talking about kind of network spares or having more things on hand to be prepared for these kind of incidents.
Yes, that's correct.
Yeah. So the IEMs do account for network spares. So businesses are allowed to include as part of that regulatory asset base that I talked about, not just the active assets that are on the network, but also the necessary spares that are kind of prudent to have available. Where that amount is changing quite a bit over time, which we saw as part of Wellington Electricity when they applied for a customised path around earthquake resilience in 2018, that was now. Acquiring a greater number of network spares than they'd had historically was one of the drivers for that. So on a forecast basis, we can take that into account. And it's, a really good question for us, I think, to consider as part of the CapEx forecasting limb of what we're doing, whether the need for more spares is driving spend. Does that cover the question?
Yes, thank you very much.
Cool. No problems. Anything else? No? Okay, so turning to the DPP4 reset, as we said at the beginning, not really going into the details of consultation on this. There will be plenty of time for that over the next 18 months. But obviously just acknowledging that, as the last question showed, the context for this DPP does differ from that of the last reset and the ones before it. Obviously, decarbonisation now with the Zero Carbon Act in place and the emissions reductions and national adaptation strategies in place, things are, quite different from where we were 5 years ago. It's now a long-term goal, and networks are going to have a really important role to play in that. And so our challenge lies really in working out when that's going to occur and what the impact of that will be on investment needs. So I think definitely one of the focuses of our expenditure forecasting work is going to be consulting with stakeholders how much investment we're going to see over the next 5-year period. In terms of the DPP process, we've kicked it off with a process paper, which I think went out in May this year. Thank you for those that have sent through submissions on that. Obviously, we earlier, as part of the work on the IMs as well, held a workshop focused on expenditure forecasting. And today we've obviously got this knowledge sharing session. In terms of where we're going from here, so where are we now in August? So we will be having an issues paper going out in Q4 of this year. So that's the sort of next major milestone that you'll see from us. Basically, what that will do is set out in a lot more detail how we view the context that we're in, and the kind of types of changes that we're considering to the expenditure quality and incentive rules that we put in place. Obviously, be a period for submissions and cross submissions on that. And then if necessary, if we identify anything there where we think it's worth a more targeted discusussion to kind of expand on that work with stakeholders, we'll look to hold issue-based workshops on that, either sort of fourth quarter this year or early next year. Draft decision we're targeting in May, and obviously allowing a submission period on that. And then if necessary, any follow-up workshops there, heading towards a final decision by 30 November 2024. And if there's no further questions, or any...
Just give a second for a few questions.
Yeah. Yeah, sorry, any further questions from the floor? I got a question from Feng.
Hey, I just want to clarify the 53ZD notice between September to December. It says including quality of service / 2024 expenditure forecast. So are you expecting the 10-year forecast as part of the 53ZD notice? And when we say quality of service, does it refer to that we need to provide SAIDI and SAFE forecast as well?
So I think on the quality side, I can answer that one. Unlikely to be forecast data for quality there. I think what that will be is the historic data set. Obviously, we collected that 5 years ago, but there's 5 years worth of new information since then. So it'll be refreshing that historic interruption data set we use, and also some of the changes in the ID space around how SAFE is interpreted. Apologies, this is not my area of deep expertise, but I think it's focused on some historic data. I might pull Simon in here for a question on the expenditure side of things.
Yeah, it's not clear that we will use a Section 53ZD notice to request the 2024 expenditure forecast in advance. But as we indicated in the process paper, and as you can see from the timeline here, if we get the AMP submissions at the end of 31st of March, and we're looking to get a draft decision in May 2024, that's a very challenging time frame. So we're going to look to issue something to suppliers shortly to indicate, I guess, what's going on with our 2023 AMP review process and how that'll tie in, and that'll include some initial thinking about that 2024 expenditure forecasts. From our side, we're interested in being clear on the significant changes in forecasts between 2023 and 2024, but acknowledge suppliers need time to work in the types of challenges which you're intending to reflect in, including the impacts of Cyclone Gabrielle and the changes which that's created from 2023 to 2024. So you're not definitive that will be a Section 53ZD notice, but that's still an open conversation about thinking about what we may request potentially earlier than the 31st of March in regards to the 2024 expenditure forecasts.
Okay, thank you.
Cool. Okay.
We will pass to Josh in a minute, but just like to thank James then for that presentation. We'll come to a question in a minute. There's been a lot to take in, and we appreciate people on the call. As we noted, there's been a number of people who have joined late during the call. The presentation itself will be made available on the website, as will the slide deck. so you can have a chance to look at it for those who came a bit later into the process. But we do have another question from Farhan.
Hello, can you hear me?
Yes.
Yeah. I've noticed on like the formula for the regulatory asset base where you have capex, you have plus capex there.
Yes.
Would that was like factored into the maximum allowed revenue. And what I would want to know is that if a company is an EDB is regulated, that would mean that if they focus more on investments or just like increase their investments on assets, just increasing their capex, that would mean that their maximum allowed revenue would be higher then. And would that be like an EDB can just abuse that aspect just to get more allowed revenue?
Yep. No, that is a good question, and it is a that sort of, I guess, gold plating problem could be another way of phrasing what you've said there. I think the first response there is that's part of what the CapEx scrutiny process that we described in the latest slides on CapEx forecasting is looking to deal with. That there is an incentive there for over forecasting in the first instance, but also overspending. So those ratios that we're talking about, or the qualitative scrutiny that we're going through, is to assess that those CapEx forecasts are prudent and efficient, so that they're driven by a real need on the network, and are being delivered sort of with reasonable efficiency. But the other aspect of this, and apologies for not covering it in detail, part of why we have the IRIS mechanism is so that where we are seeing kind of large increases over and above that CapEx baseline, either the business applies to have that expenditure approved, either through a reopener or a customized price quality path if it's very significant, or that investment is done partly at their own expense, so they do see an incentive penalty effectively there if there's a significant overspend. But yeah, no, it's a good question, and a kind of a real risk that we're live to.
Thank you.
Right. No worries. This will be a very rapid tour back through all of the animations. While we're doing that, just check if there are any further questions, and obviously happy to engage further as the process goes on if you do have anything come to mind. Okay, if there's nothing else, I'll call Josh back on camera to close us out.
Thanks, James. Unahia, unahia, unahia ki te uru tapu nui, kia wātea, kia mama, te nākau, te tinana, te wairua i te ara tākata. Koia rā e rongo, whakaria ake ke runga, kia tina, hui e, tai ki e. Thanks, guys.
Thanks all very much.